investors are heading into 2025 with a sense of guarded optimism, particularly with respect to US equities and the potential beneficiaries under the new US administration. Expectations of tax cuts, more fiscal spending and deregulation have triggered a significant rally, particularly for financials and asset managers in November 2024, as market anticipate a broad pickup in M&A activities, accelerated listings and exits. Global M&A activities have fallen to decade lows post-2022. At the start of 2024, we postulated that the peaking of interest rates and strong equity market backdrop would result in an increase in transactions and recovery of valuations in private equity. These expectations did play out, but the pace and degree of improvements proved to be very gradual. We believe returns in private equity will continue to recover as deal volumes have turned the corner. For US exposed managers, the outlook for 2025 is positive given on the back of the removal of uncertainties and continued soft landing of the US economy, as well as the potential boost from the pro-growth stance of the incoming administration. The improved outlook for private equity transactions in the coming year is expected to be positive for private credit as well, as M&A activities drives more loan demand and fee incomes. We are cautious on fixed income and duration exposures as the new administration's more restrictive immigration and tariffs policies could result in a stalling of interest rates. Private credit offers compelling diversification in this backdrop, especially for yields-focused investors. The backdrop for global markets is expected to remain both risk-on and volatile, which creates opportunities for hedge funds to deliver alpha. Most hedge funds managers welcome the pro-growth stance and deregulation from the incoming US administration. They are monitoring carefully the impact on US treasuries and risk assets outside the US, as well as taking proactive stance to hedge against tail risks in credit. While returns across alternatives have moderated in the past 3 years, we see the headwinds easing in 2025. Sharp rise in financing costs. The difficult transition to a new operating environment have depressed performance of private market investments in the past 3 years. With interest rates stabilizing and tailwinds for corporate activities and M&A, we are expecting private market returns to improve in 2025.
Furthermore, investors continue to face a market regime where features like elevated bond yields and greater volatility could recur against a higher for longer backdrop. For investors who are concerned about downside risk and volatility, a suitably diversified portfolio, including in alternatives, should take on a renewed focus in 2025.